So thank you for the introduction, Seth, and it's a pleasure to be here. There aren't many of my friends who really like to reimagine the pension, but I actually think this is pretty exciting. I don't really have a proposal. I'm more here just to describe what we do. And it's a great pleasure to be here. I think what we've tried to do, it really started with its roots in the pension world. Bill Sharp used to consult the pension plans and in the mid-'80s, and when he saw 401ks really on the rise, he saw a big shift in responsibility and risk sharing to the individual. He thought, you know, individuals need the same kind of help I've been providing to the pension fund managers. And so our job was to use technology to create services to help people who don't have a lot of money and who are traditionally ignored by the financial services industry. And we thought if we could create a service that provided good, high-quality, independent advice to people who don't have a lot of money, that could be a great opportunity, but also could provide a big service to the world. So we have been offering our services for a long time. We have a lot of customers, and I'm going to speak much more, not about what the ideal is, but what the reality is when all these people call us on the phone. And, you know, 15 years ago, the baby boomers were 15 years from retirement. We knew it was just a matter of time that they were going to find themselves on the doorstep of retirement, and suddenly the question was going to shift towards, what do I do with this money, and how can I possibly live comfortably in a world where the stock market's going up and down? I don't have as much as I thought I was going to have. My benefits are much lower than I thought they were going to be, and I don't know how long I'm going to, and I'm not sure that this money's not going to run out. And so what we had to do is design a solution that not only would work for individuals, but would also work with the sponsors, the plan sponsors, the employers. And so we looked at this and said, well, we're going to have to play with the hand we were dealt. All right, there's only a certain amount of money. As far as we're concerned, if taxes are raised or something else happens, that's great. Our people have a certain amount of money, and not very much. So we've got a certain amount of money. We decided, and our employers made us decide, we're going to have to play by the rules. We can't wait for any legislation. People are retiring now. You need something that works now under existing laws and regulations. And then finally, and Mark Avery mentioned this earlier this morning, we're going to have to play by the current terms that are dictated by employers and employees in terms of what they want, how they choose, and how they behave. We're not going to try to tell people that they should do something different than they want to do, than what they want to do. And so we created a service. It's an extension of our professional management program called Income Plus, and I'm not going to sell Income Plus to you. But what I do want to do is to give you an idea of what this framework is. Because a lot of other people could use the same framework. It might be a useful way of thinking about not only how do you deal with a 401k or a DB, but how do you combine elements of Social Security, of defined benefit plans, and of 401ks, which is a broad category of risky assets. Could be IRA accounts, 401ks, et cetera. And what we've done is we've designed something that we think really challenges conventional wisdom on pensions. So, for instance, with this kind of a flexible income framework, it's possible to get lifetime income out of a 401k without putting an annuity into the 401k plan. Okay? It's possible to use your 401k to substantially increase lifetime income by deferring Social Security. For a lot of people, a lot of our customers, that will probably be the most important choice they could make to increase their income in retirement. It's just the truth. Now, whether they will or not is a separate question, and that has a lot to do with framing and communication and behavior. It is possible for cash balance plans to provide lifetime income, and it's possible when someone takes a DB lump sum, it's possible for that lump sum to provide lifetime income. In fact, a lot of our clients are thinking about rolling over the DBs into the 401ks and using this flexible income framework to provide lifetime income out of their 401k plan. And even though DBs are really great in certain ways and 401ks are great in other ways, we believe that the optimal solution for most people is a combination of both of those things. The way we think about it is in terms of building blocks. Pensions and annuities give you a certain type of building block. They can give you mostly longevity insurance. You can't get that from investments. Equities give you growth potential and downside. And fixed income and things like Social Security and annuity give you a nice income floor. And that little picture of there is just a general view of how we have created this framework, and there's nothing proprietary about it. But I think it's a powerful way of looking at the problem. So what on the far left is age 65, on the far right is out past age 85. And we heard employees say, number one, I don't want my payouts to go down once I start getting them for my 401k. And so we said, all right, well, the first thing we're going to do is set aside about 60% of the money in fixed income investments, where we're trying to match the duration of the bonds to when they need that payout. And if you can match the interest rates, those payouts will be insensitive to interest rates. And because they're in bonds, they're also insensitive to equity. So if the equity market drops, that number one, that fixed floor of income between 65 and 85 does not drop. The second thing they said was, I don't want my money to run out. There's a very efficient way to deal with that. It's longevity insurance. And so what we do is we set aside 15% of the portfolio. We say, you're not going to spend this. This is going to be set aside so that when you turn age 85, if you want to, it's optional, you'll have enough money to buy an annuity outside of the plan. So we really push the longevity insurance question to the end of the life where you get a higher benefit for dollars spent, and that way it's not in the 401k plan because a lot of sponsors are worried about having default risk in the plan. And then the third thing they said was, I want to be able to have some growth potential if markets go up. So we actually take 20% of the money at age 65 and keep it in the stock market, and every year convert some of those equities into a higher income floor. We actually add on to our income floor on number one, and we top up that set aside so that they're going to have enough money to buy that annuity if they want. And if you're wondering, you can certainly configure it to be a single life or joint and survivor. Of course, it depends on the individual circumstances. So what you get over time is a set of payouts that are coming from your 401k that step up on average 2 to 3% per year. If the equity markets do really well, it'll step up faster than that. It'll be better than inflation. If the equity markets don't do very well, it won't happen that fast. There's no inflation guarantee associated with this. Really, there's no magic at all. But the idea is that equities are used for the upside, fixed income is used for the floor between 65 and 85, and insurance is used at the tail end where insurance is best. So our job is to use the best building blocks and put them together in a way that meets the needs of participants. And what we're really excited about are the possibilities of, instead of having a fixed floor, having slightly higher payments for the first couple years in order to delay Social Security. You get a much bigger Social Security benefit by doing that. You can imagine companies in their DB plans offering that longevity insurance as part of the plan on a really big basis, so you can get very low-cost longevity insurance as part of a group policy. You can imagine this whole thing working in a cash balance kind of context. And so we really think that DB plans and DC plans have elements that when you put them together can provide the kinds of payouts that give individuals the flexibility they want in terms of being able to access their money, but also the reliability of income for life. So those are my comments, and hopefully we'll have a lot of questions.